Welcome. We're all familiar with income taxes. However, there are some tax planning myths and some tax planning strategies that we'd like to explore today. Joining me is Mike Cates. Well, welcome, Mike.
Well, thank you, Dirk. It's good to be here.
It's good to have you. So, one of the things we hear as tax professionals is you can judge the quality of your tax accountant by the size of your refund. Is that true, Mike?
Well, certainly, Dirk, the preparer does impact the size of the refund or the tax liability. But I think in many situations, or even most situations, the client circumstances, the income, the deductions, the withholding has a bigger impact on the tax refund. I certainly would look at the preparer's experience and credentials, and if the preparer wants to base their fee on the amount of the refund, run, don't walk, run toward the door.
Absolutely, absolutely. So what is the average tax refund these days?
The average tax refund for the 2015 filing season, which would have covered 2014 returns, was right at $2,700. $2,701 was the actual number. That was through May of 2015. What's kind of interesting is if you look at the statistics, the early filed refunds, if you look at the statistics through, say, the end of February, those refunds will average closer to $3,500 or $3,600.
Right.
Because the people who have a big refund coming
are more anxious to get the
filed.
refund, right?
Yeah.
So is it good or bad to have a refund?
Well, I'll give you the answer to all good tax questions. It depends.
Right.
Many clients view a large tax refund as a forced savings account, and if that's the only way that we can get them to put any money aside, then it's a good thing. In my mind, it's typically not a good thing because it means that the IRS has been using your money all year.
Right. Well, in the case of your $3,600, that's $300 a month.
Exactly.
That they could have been using and consuming.
That's exactly right.
And
you see so many clients that have to use credit cards to get through the week or through the month or through the year, and then they use that tax refund to pay off the credit card debt. If they'd simply got the withholding right to begin with, they wouldn't have had to run up those credit cards all
right,
year.
And paid the interest expense.
Exactly. They could have saved that interest because we used to say, well, throw the money into a savings account. Accounts aren't paying much now, but at least we can keep them from racking up a bunch of interest.
Right. Well, great. One of the interesting things I always used to run into is a lot of people getting their post-secondary education and taking out student loans. And then once they got that master's degree, that MBA, whatever it was they were looking for, they would be looking to write off the student interest. And all of a sudden they had been told that student interest on student loans was deductible, but all of a sudden it isn't, which is kind of something that surprises a lot of those students.
Sure. There is a provision that allows up to $2,500 annually of student loan interest, or qualified education interest is the technical term, to be deducted as an adjustment to income. Now, what that means is that it's deducted on the front of the 1040 down near the bottom of the front of the 1040. What that means is that you don't have to itemize. You don't have to file a Schedule A in order to take advantage of that deduction. But there's about 3 or 4 different reasons why a person paying student loan interest might not be able to take that deduction. First of all, a married couple has to file jointly in order to claim the deduction. Secondly, if you're claimed as a dependent, then you cannot take the student loan interest deduction. Third, and this is kind of an odd one, but third, only the person who is legally obligated to make the payments is allowed to deduct the interest on those payments. And then the one that you're probably looking for, the one that affects most taxpayers, I suspect, is that there is a phase out or an elimination of the deduction based upon the taxpayer's modified adjusted gross income, basically the adjusted gross income.
Right. So the good and the bad is you're no longer eligible for it because you're making more money.
Right.
So
yeah, you make too much money.
You make too much money to do
it.
it. So it's kind of a good with a bad or a bad with a good.
Exactly.
All right. Well, Mike, what are some of the top tax planning strategies to consider?
Well, there's generally about 4 broad tax planning strategies. There's tax avoidance, there is tax deferral, there is income shifting, and there's conversion. And
well, there's actually a 5th one, but it's illegal.
Well, yeah, tax evasion is the one that we should probably avoid.
Exactly. So, Mike, can you give us some examples of deferring income?
Sure. There's 2 main techniques for deferring income. There's kind of a double bonus, if you will. Most of the deferrals that taxpayers are allowed to make either impact their education funding or their retirement funding. And so while we're deferring income, which of course reduces our tax liability, we're also getting the benefit of putting money away, putting funds aside either for retirement or for education. On the retirement side, we've got the typical 401k, 403b, or 457 if you're with a non-for-profit, or a simple plan, which are certainly gaining in popularity. We also have deductible IRAs. All of those will defer income. They'll reduce, in most cases, they'll reduce not only the current income, but the funds that are accumulate on those accounts grow on a tax-deferred basis. So we're postponing the taxation. On the education side, we've got the 529 and the Coverdell.
Right.
And those are the two most common there.
Right. And of course, kind of the new darling, which is health savings accounts for high deductible plans on insurance.
Health savings accounts are huge, as are the flexible spending account. Obviously, the FSA isn't as big of a deal now as the HSA, but both of those have an added benefit, if you will. Not only do they come out pre-income tax, but if they're done through an employer, which the FSA has to be, if they're done through an employer, it also saves the Social Security component. So for a client in a 25% tax bracket, they're saving the 25% income tax plus whatever state bracket they're in, if they have a state bracket, plus they're saving the Social Security.
All right, well, great. Well, what's a way to accelerate deductions?
Accelerating deductions isn't one that I had mentioned, but that kind of falls into that avoidance category. And avoidance in general is the use of allowable exclusions or deductions or tax credits. But I'll generally recommend accelerating deductions in two situations. First, if a client's in a tax bracket higher today or this year than they will be next year, then I'm going to want to pull some of those potential deductions from next year into this year where they're going to give more bang for the buck. Secondly, if we've got a client who, for example, because their mortgage interest is getting smaller every year, which it tends to do, they're right on the verge of not being able to itemize. And so we might want to bunch itemized deductions by dragging some of next year's deductions into the current year. We've got more control over, for example, charitable contributions.
Right.
One of the common acceleration techniques would be to pay the January estimated tax payment in December to pull that deduction into the current year. Another one that doesn't get used too often is to pay January's mortgage payment early enough in December to where it gets credited to the account and we've got that extra mortgage interest in that current year. Most of those techniques don't work year over year, but they're very good for, as I said, either bunching itemized deductions or helping somebody out who's going to get killed this year, who might not be in quite as high of a bracket.
Certainly those work for people who have non-steady forms of income.
Absolutely.
Where their income may vary greatly from year to year.
Absolutely.
So Mike, is there one recommendation you make to all of your clients?
There is one recommendation I give to most clients, and used to be I would have had the client fill out a paper W-4 to determine the accurate withholding. Most clients don't like filling out paper forms much anymore, so I recommend that they go out to the IRS website, irs.gov, and in the upper right-hand corner there is a search function that works pretty well. Type in withholding calculator and have your last pay stub available, and go in and fill out that withholding calculator to get the withholding right.
Well, Mike, any final thoughts?
Well, Dirk, there's actually a couple I thought we might talk about overlooked deductions, but that's kind of the same idea. There's two deductions that tend to be overlooked in many cases. One is the saver's credit that applies to individuals who are saving for retirement. Can't be used by everybody. There's an AGI limitation that's at a fairly low level, but I see that one missed quite a bit. The other one is the earned income tax credit, which, depending on the number of children, can apply up to almost $50,000 of income. And most people think of that as a low income credit, but not necessarily so.
Well, Mike, appreciate you being here today.
Dirk, it's my pleasure.
Well, we hope this session helped clear up some of the common tax myths and provided some strategies to help for your future. Thanks for joining us.